In 2009, General Motors' market cap went to zero. Its stock price went to nothing. And nearly a month later, someone purchased that business. So how much did they pay for it? Well, understanding the answer to that question will give you an instinct for one of the most important concepts in investment banking interview technicals, and that is enterprise versus equity value. It's one of the trickiest questions throughout the whole process, mostly because people memorize an answer without truly developing an understanding or an intuition for why. And in this video, we're going to cover that topic and help you sound smart in an interview when talking about enterprise and equity value. If you're new here, my name is Michael. I'm the founder of OFFERGOBLIN. I'm ex-Centerview, and I make videos on how to get into investment banking. This is a part of a technical series. We've talked about the 3 financial statements. We've talked about margins, and now we're going to talk about the 2 types of valuations. To be specific, that's enterprise versus equity value. And the way that you can think about that is a price tag on a business. So today we're going to talk about the definitions of those. We're going to talk about why each one gets used, and we're going to work through real interview questions so that you are prepared to sound smart when it's your turn to speak on this topic. And at the very end, I'm going to give a 60-second super strong, polished answer to what is the difference between equity and enterprise value. So stick around for that. All right. So first, let's talk about the 2 price tags. The first tag is equity value, and that's what shareholders own. The way to think about that is it's the number of outstanding shares multiplied by the share price. The other price tag is the enterprise value, and that's what it would cost to buy the business from everyone who has a claim on it. So back to General Motors. If the equity value of that business is 0, there are no claims from shareholders, but there still are claims on the business. What might some of those be? Well, for one, debt. Presumably, they purchased a lot of those factories and other capex using debt. So if you were going to buy General Motors, you'd need to pay out all those debt holders. And in that sense, it's really the lenders who actually own those assets, which is why even though the business had 0 equity value, factories were still open. The business was still operating because that portion of the business is owned by lenders. So in investment banking, the main focus is on enterprise value. Because when you're dealing with one business which wants to acquire another, they have to pay the enterprise value to purchase out the entirety of the business. To summarize all of that, equity value is what the owners have, and enterprise value is what everyone has. Equity value is usually the easier concept to understand because it's listed on any company's Yahoo Finance page. That would be the market cap of the business. What it essentially represents is how much value shareholders have in this business. And it sits at the bottom of the capital structure, which means that if anything happens to the business and any sort of cash is going to come out of the business, let's say that they were distressed, the equity holders at the bottom of the capital structure get paid last. So the equity value isn't really what the company is worth. It's more like what is left. And equity value is a lot more used by people who are thinking about the business as a investor, in the sense that if I'm a hedge fund and I can buy out 20% of the equity value of a business, that can give me meaningful control, whereas the debt portion isn't as relevant to me beyond the stability of the business. A lot of IB candidates get equity value questions wrong before they even start the calculation. I'll start by saying there are 2 share counts, basic and diluted. So equity value is share count multiplied by share price, but in investment banking interviews, people often get the share count wrong. Well, there's 2 forms of share count. The first one is basic shares, and that's shares that exist today. And the second one is fully diluted shares, and that's basic shares plus claims that could become shares. And this is important because buyers can't just think about the shares that are trading today. Other people may already have the right to buy or receive shares later, and those claims can increase the amount that the buyer must pay. So some examples: options, the right to buy shares later at a fixed price; warrants, similar rights usually held by investors; RSUs, shares promised to employees; and convertible debt, a loan that can turn into shares. But don't overcomplicate it. You do not need to treat every claim the same way. You just need to identify what it becomes, debt or shares, and then count it in that form. So the underlying rule is to count every financial claim. Count each claim once and never count the same claim as both debt and shares. So basic shares show what exists today. Fully diluted shares show what buyers will have to pay pay in the future. So once you have equity value, you can build the value of operating the business. So starting with that equity value, which is the value to common shareholders, we're going to add debt. We have to pay off all the lenders. We're going to add preferred stock. We have to pay off all those jerks. We're going to add non-controlling interest. We're going to buy out all of the investors in our subsidiaries. And then we're going to subtract cash. Cash is not a part of the core operations. And we're going to add equity investments. That's stakes in other companies that we don't control. So essentially what you're doing is adding financial claims to the business and subtracting assets that are outside of the business. You pull all of that together, and that's what enterprise value means. So there's two interesting adjustments to enterprise value that we should talk a little bit more about. People often get confused by these in investment banking interviews, and that is non-controlling interest and equity investments. So non-controlling interest is the portion of our subsidiary's equity value that we don't own. So let's say that our rocket company owns 80% of a subsidiary. That remaining 20% are people that we would need to pay out if we bought this rocket company. That's the non-controlling interest. So we're adding 20% to our enterprise value. On the other hand, we have equity investments. They might own 10% in another business. They don't really control that business. That's actually treated a little bit more like just a liquid asset. And so that value is actually going to be subtracted from the enterprise value. In the same way that we subtract cash, these are two core ideas to understanding enterprise value and the relationship that our target company has with other businesses. So let's get into a Morgan Stanley Super Day question that challenges your conception of enterprise value. The question is, what is the effect on enterprise value if a company pays down debt with cash? So from first principles, let's think about that enterprise value equation. We're adding debt and we're subtracting cash. So if we lowered the amount of debt that we have, we'd be lowering the enterprise value. But at the same time, our cash is going down as well. And cash is a negative term, which would be raising our enterprise value. So on net, there'd be no change to the enterprise value. And this is why oftentimes people group together these two terms as net debt, because it's also understood that the cash that's in the business would be used to pay off debt holders if the business were ever purchased. So if you understand that concept, then you'll at least be able to understand deeply these two terms in the enterprise value formula. There are other things that change enterprise value. And this is a very common format for an investment banking interview question. And one of the core ways to think about it is, did the operating of the business actually change? If not, then likely there was no change to enterprise value. So for example, let's say a company issues stock. What's going to happen is that the equity value will increase because the number of shares outstanding will go up. But at the same time, the cash raised from doing that will also go up, which is a negative term. So enterprise value wouldn't change. Another example would be debt. Debt's a positive term. Debt goes up. Cash goes up as well. They cancel out. Well, what if they borrow money and then they buy back stock? So they borrow money, debt goes up, cash goes up, those cancel each other out. Then cash goes down, increasing enterprise value, but shares outstanding goes down, lowering enterprise value. But let's say the company buys an asset, an operating asset. Well, then the operating business becomes larger and enterprise value rises. So you'll get this question all the time in interviews. Did enterprise value change? And there's really two cases to that. The first case is that it's only financing. So for example, a company borrows money to buy back shares. Well, they raise their debt, which increases enterprise value, but they've also raised cash, which is a negative term, so that cancels out. And then they spend that cash, which raises enterprise value, on stock, which they buy back, which lowers equity value. So all of these actions cancel themselves out and enterprise value doesn't change. On the other side, the operating business actually changes. So for example, they use cash to buy equipment. Well, cash goes down, that raises enterprise value. Equity value may not immediately change because all they've done is trade $100 asset cash for another $100 asset PP. But the enterprise value goes up because there's less cash dragging it down. Here are 3 traps that you'll run into in your investment banking interviews relating to the topic of enterprise and equity value. The first one is out of the money options. These are options whose strike price are greater than the share price. These should not be included in fully diluted shares outstanding because they won't be exercised. The second one is negative enterprise value. Enterprise value can be negative. That could be the case when a company holds a ton of cash, for example. It's unusual, but it doesn't mean it's impossible. And the third trap is operating versus non-operating assets. Something like a corporate jet used by executives is probably a non-operating asset and wouldn't raise the enterprise value of the business. So whether that's included in enterprise value is dependent on how it's actually used. So be careful not to classify assets by their name, but by what they mean and what it's used for. All right, so here is the 60-second answer to the question, what is the difference between enterprise and equity value? This is a question that you will get in your investment banking interviews. Follow me now. Equity value is the value attributable to common shareholders. It equals the current share price times the fully diluted shares outstanding. Enterprise value is the value of the core operating business. It's capital structure neutral, which makes it easy to look at different businesses. To move from equity to enterprise value, we're going to add net debt, add preferred stocks, add non-controlling interest, and subtract equity investment. And if you can understand all of that, you've got a good chance of being able to field this question in an actual interview. That's the end of our topic, and I highly recommend that you go look at the practice questions that we posted in the description. It'll guarantee you a little bit more of a sense of how this is actually asked in an interview. You should like and subscribe to this page if you want to hear more. We've been growing out this channel and have really enjoyed interacting with all of you. I'm Michael from OfferGoblin, and I'll see you next time.